Hello ladies and gentlemen, my name is Lars Schall, and on behalf of Matterhorn Asset MGMT I welcome you to a special interview that I will conduct now with the founder and head of the Pacific Alliance Group in Hong Kong, William S. Kaye. Bill, we want to talk about the motive, the means and the opportunity to suppress the gold price. What is the motive?
Before we get to motive, let's just say it's basically been documented that the price is suppressed. I'm not sure all of your viewers would be aware of this, but you interviewed recently Dimitri Speck. I'd encourage people who haven't read his book to read it. I think he does a very good job of documenting this suppression scheme, and it's been going on for a very long period of time. So the motive is very simple in my view. That is, a free price, a free market price for gold would essentially cast all these central bank interventions for what they are. In other words, a free market price for gold would potentially destabilize the policy measures being taken by the US Fed, by the European Central Bank, by the Bank of England and others. And since the central banking community, at least up until now, has been in a position because of their own holdings or their own access to holdings, to, through the bullion banks, lend gold into the system that, in my estimation, will never be returned. They have been in a position to prosecute a suppression scheme that creates the appearance in the market that central bank policies are sound, when in fact, in my judgment, these central bank policies are not sound. All right, you simply can't expand central bank balance sheets exponentially, as has been going on in recent years. US Fed, the purchase of essentially toxic debt by the ECB to help bail out basically Italy, Greece, etc. You can't pursue these types of policies, which in my estimation the market would see as being flawed, without the price of gold, unsuppressed, going much, much higher. So that's the purpose of the intervention.
What are the means?
The means are also basically quite simple. The central banks have some gold. In my estimation, because this scheme has been going on for a long period of time, as Dimitri and others have mentioned, they have far less physical holdings of gold than they report. But they have access to gold. The Bank of England has access to other banks' gold. The Fed has access to other banks' gold, including, as we know, Germany, which is having a difficult time getting that gold returned. So the central banks have access to the gold, irrespective of whether it's their own gold or not, and have swap and lease agreements which allow them to lend this gold into the market through the agent bullion banks. And the bullion banks are large commercial banks that are active in gold and are essentially the agent banks for the big central banks like the Fed. And there are banks like JP Morgan, Goldman Sachs, and a few others, but mainly big commercial banks who are just very, very active in the gold market.
And they have no problem with it that the asset that they sell is worth less than it could be?
No, they have no problem with this at all. To begin with, it's not their gold. So when Alan Greenspan was head of the New York Fed, the price of gold mattered not at all to his salary. You know, he had policy objectives, and if suppressing the price of gold furthered those policy objectives, and that's obviously what he would seek to do. And I think the same can be said of Bernanke and now Janet Yellen. So policy objectives matter, and this is why the price of gold gets suppressed as basically a policy objective. But the price of gold per se to these people does not matter.
Do you think it is a problem that the central banks claim as an asset the gold they lease out, as if they still have it?
Yes.
Isn't this pretty much Enron accounting?
Well, it is and it isn't. It is in the sense that they are falsifying to the public their true position, which of course is exactly what Enron did. It's different from Enron in the sense that Enron was a private corporation which basically chose to create a scam which operated with apparent success for a period of time and then, like almost all scams, imploded. But this was a corporation with a limited balance sheet. Central banks have unlimited balance sheets because, as they've already demonstrated, they can digitally print all the money that is required to cover their obligations. So in that sense, it's not Enron accounting, because the way this works, and I think this needs to be understood by people, is the Fed wants to suppress the price of gold. So they call up, say, JP Morgan, and they told JP Morgan to sell 30 tons, 40 tons, 50 tons of gold. And what happens is the gold is physically supplied to the agent bank, which then sells the gold. And the Fed would get back a piece of paper which says that JP Morgan owes them that gold. And if you do this for an extended period of time, and this has been going on, we know, for a very long period of time, these obligations become enormous. Now, on the one hand, it would be fair for the auditors to say, well, JP Morgan, if the price of gold goes up or whatever, JP Morgan can't possibly return on their balance sheet all this gold. To which the Fed can correctly say to the auditor, well, that's okay. We've already bailed them out to the tune of tens of billions of dollars, once already. So the Fed could just assure the auditor that it's not going to be a problem, that they can digitally create all the money necessary, that if they wanted the gold returned, and I think people need to understand, in my estimation, none of these central banks ever expect or even want that gold back, okay? They just want to continue their scheme as long as they can. But the way you deal with the auditor is to say, we can create the resources necessary and lend it at no interest to JP Morgan and Goldman Sachs, so that if that day came and they had to make good theoretically on this piece of paper, they would be able to do so. And the auditor, upon getting that assurance, would simply sign off because this is indisputable.
You've mentioned Dimitri Speck, and Dimitri demonstrates in his book that the gold price is rigged systemically for almost 20 years now.
Yes.
So I think this was the first market that was rigged systemically. And the question would be, do you think that the rigging of the gold market is a precondition to rig other markets? Or is it rather vice versa? Since you rig the gold market, you need to rig all other markets?
Well, that's a very good question. I think it's part of a coordinated policy. So let's take what we do know. What is public knowledge is central banks routinely intervene in major financial markets, and they admit to it. Part of Fed policy is to maintain cash levels or very short-term rates at approximately zero. That's a policy objective which is public, okay? And they intervene very seriously in order to maintain that rate so that it doesn't lift above this target rate. They also, as a matter of policy, engage in what is known as quantitative easing. And what that means is they're buying billions of dollars, every month in securities as far out as 5 and even 10 years on the Treasury spectrum, as well as mortgage-backed securities, Fannie Mae, Freddie Mac, and so forth. So these are publicly known interventions, and they have consequences. There are consequences to maintaining a zero-bound interest rate. Okay, the consequences to maintaining artificially low interest rates, which buying, say, $85 billion a month in treasuries and mortgage backs accomplishes. You've got demand that would not exist, which artificially suppresses interest rates even farther out on the curve. So this is public. Interventions in the currency market are also known. You know, banks such as the Reserve Bank of India routinely intervene to either suppress their currency or to support it. Very recently, the Reserve Bank of Australia, which is not one of the bigger offenders, publicly admitted that they were selling Australian dollars because they felt their currency was too strong. So there are many instances of this. There's virtually no market outside of, arguably, the equity market, at least as it relates to the United States, in which it has not been publicly acknowledged, but it has been admitted to, under oath, that they have the ability to do this.
Yeah, and you have the plunge protection team.
The plunge protection team, it's actually called the Working Group on Capital Markets, but popularly, yes, the plunge protection team. And one of their stated objectives when it was created was to prevent another crash. This goes back to the Reagan administration and the '87 crash. So we have reason to believe, since that was why the statute was created, that where it is seen as appropriate to central banks, so there's also intervention in equity markets. So now that brings us essentially to precious metals. You know, we basically covered the other important markets. And there, I think Dimitri and Gata and others have done very good, intensive research and have just documented that these interventions do occur. And it's coordinated in conjunction with the interventions we've already discussed. So in other words, if you're going to pursue policies in which you're going to greatly expand central bank balance sheets, you're going to engage in very aggressive money creation, you're going to maintain interest rates below their natural level, because that is the objective of the policy. It is important as a component of that the price of gold not destabilize that policy. Because if the price of gold went up very quickly, people would be concerned about these policies. They would question the soundness of money. If the dollar, if the euro were quickly losing purchasing power versus gold and silver, there would be great concern about these policies. And people would begin to adapt very quickly so that they're saving more in precious metals, which central banks don't want to see, and investing less, let's say, in the real economy and in, say, dollar-denominated assets or investments. And this is something central banks who are trying to encourage more risk-taking. This is something that they don't want to see.
Yeah. Do you think that the central banks will lose the control over the gold price?
I think inevitably they will, and that day will happen when central banks no longer can make delivery that is necessary from their own inventories in order to maintain the price suppression scheme. And there's already reason to believe that we may be getting close to that end game.
One central bank that is completely out of tune with Western central banks is the Chinese central bank.
Yes.
Why are they buying so much gold?
I think they want a gold-backed currency. I think this is an objective that was adopted by the State Council a number of years ago. Reinforcing that objective was a policy measure of encouraging their own population to save in gold. So now we have a situation that between the People's Bank, which doesn't admit how much they buy, but we know that they're buying aggressively, and the population, China currently is importing on our numbers very close to 100% of global production. So you've got incredibly robust demand from China, both for the central bank and the population. You've got the likelihood of India reappearing quite soon because a change in government is expected soon that is much more friendly to gold acquisition. So we're very likely to see India demand inflated, once again. It wasn't until really last year that China surpassed India in gold consumption. And I think India will resume its place as a very strong number two to China going forward. And of course, we see fairly robust demand from Russia, Brazil, and other places. So the numbers simply don't work. In other words, there simply isn't enough gold production to satisfy the known demand. There isn't enough net selling, in other words, from ETFs and from households, whether they're in the US or Europe, where there is very little, if any, net selling actually taking place. It's very hard to make these numbers, sum correctly. So the only answer when one goes to the arithmetic is that central bank inventories or access to other people's inventories are supplying the difference. And the question is, when can they no longer do this? Because obviously this is a self-limiting process. There's a finite amount of gold available to these central banks, and when it becomes too low, that this game simply ends.
How is it that the Chinese gold buying does not affect the gold price?
Well, we can't know that it doesn't affect the gold price, but we can know that the price of physical gold is not being decided in the physical market. The price of physical gold to date is being decided in the paper and electronic markets. And that market can easily be controlled by central banks, with balance sheets that can be as large as they want them to be. So with high-frequency trading and with the ability to short sell, as happened in April of last year, 50, 100, 200 tons of gold on a moment's notice when they want to suppress the price and engage in a smash. At the end of the day, as long as the COMEX market, for instance, is determining the physical price, and as long as they have the wherewithal, as they do, to determine that price, then the price in the physical market can and will be suppressed. The problem that they face, the self-limiting factor, is someone has to make delivery of physical. The beneficiary, as we know in this process, is China. China recognizes what they perceive, I believe correctly, to be a big bargain. This is a 30, 40, 50% or more off sale on physical, and they're buying very aggressively. So the amount of money, the amount of gold that is being consumed in China and other consuming countries and then hoarded, not reappearing onto the market, far exceeds the amount of gold being produced each year, or that's available from recycling. So these numbers simply don't work. And what I would encourage people to pay attention to are strains in the system that suggest that it's about to break.
As you know, all across Eurasia, they are opening physical gold exchanges,
yes.
Strictly physical gold.
Mm-hmm.
How do you read this as an indication for what?
I think it's an indication of the ascendance of China and the Asian nations as players in the gold market, and the reduction in the importance of London and the West. So China is essentially taking control of a market in which they are the principal player. And as I understand it, when it becomes fully operational in Shanghai, the futures contracts which will be available must be fully covered. Now this is an important concept because part of the way that this price suppression scheme using markets like the COMEX and the LBMA in London have been so successful is the number of paper claims on gold by virtue of these markets exceeds the physical gold that's available by, on most estimates, anywhere from 90 to 100 times and possibly more. Now, this all looks like it's about to change because the Chinese are adopting a market in which they will expect much, if not most, of the trading ultimately to migrate to, in which that scheme will not be permitted. That type of leverage simply will not exist. And the number of multiple pseudo-claims, as you will, on gold that frankly doesn't exist, on imaginary gold, that will get wiped out and dealt with too, because the players in the market will be required to front up physical, with the depositories at the exchange for all the obligations that are represented by the contracts. And what this means to the investor is, without leverage, the very real possibility of a short squeeze, meaning people who have these multiple claims now will seek to position themselves such that they actually own the physical. In order to be an important trader in the market, you're going to have to actually produce the physical. It's not enough to have a piece of paper saying, this is good for, one troy ounce or 1 kilogram or whatever of gold. That system will be done with, the system as we currently understand it, and the leverage will be wiped out, with one possible consequence being, as I say, this enormous short squeeze as the paper holders scramble to get access to physical.
So you would say we haven't seen anything yet in the gold market?
Not like we're about to see, no. We haven't seen this type of unraveling at all yet.
Yeah. And would you say then, or I assume that you would say that the financial crisis isn't over yet. And so do you think that gold will be a big part of the financial crisis as it goes on?
No, I think the financial crisis, none of the issues that led up to the events of 2008 have been dealt with. They've all been papered over, and we now have layers of sovereign debt that have greatly magnified, the debt issues which were the crux of the problem, 5, 6 years ago. People need to understand this. So the governments no longer, in my estimation, have the firepower to deal with any future crisis. And this is very concerning because the amount of debt in the system at anything close to normalized interest rates, as we look at history, in other words, when the central banks lose control and can no longer suppress the rates of interest that exist in the Western world, certainly. At that stage, we are set up for the next crisis because the debt, which is enormous, has gotten bigger than it was a few years ago, simply won't be serviceable. Now, this is a huge problem. And layered on top of that are a bunch of interest rate sensitive credit derivatives in this quadrillion-dollar derivative market, which is largely opaque, which just adds to the magnitude of this problem. So at the end of the day, in my estimation, there has to be a reset. In other words, the current global fiat currency architecture is like one big financial Potemkin village. And the inevitable result is that it will implode. And 2008, in my estimation, was simply a shot across the bow. And since the governments won't have the ability, assuming they want to, this time around, to salvage the old system, we will have to have a new system. And I think that new system, when this currency reset occurs, that new system will likely be administered by the IMF. We know that they're working on a new system, they've admitted it. And it's almost inevitably, in order to have the confidence of the global population, going to have gold backing. That doesn't mean it's going to be a gold-based system, but it will have to have gold backing. And in order for it to be a credible gold backing, given the base and broad money that exist in fiat terms around the world, the price of gold inevitably, and it's just simple math, will have to be reset, much, much higher.
Do you think the private banking system has to adopt also, so that they are forced to accept gold as a zero-risk asset, so that gold is good as cash?
I think that this is one scenario, and I think this is very, very likely. My understanding is, under the new Basel rules that were being proposed, that was also, part of that, that new policy scheme. Whether it gets fully implemented, I can't be certain, but this is not theoretical. The policymakers are actually working on exactly what you're talking about.
Another big story in the gold market is everything that has to do with Germany and its gold on foreign soil in New York and in London.
Right.
First of all, would you say that Germany is required because of the system to have gold in London and New York, or could it have everything on its own soil?
When the world was on a gold standard, there were legacy reasons for gold being in other central bank vaults. And at the end of the day, the use of this gold was that the amount of your inventories in those vaults, based on whether you were running a surplus or a deficit with the counterparty country, this was all set because it was a gold standard, by gold. So you either had your supplies added to or subtracted from, and then life goes on. Now there's no such reason, and it's remarkable that there has been so little movement, in my estimation, at least until recently, for countries to demand the repatriation of their gold. And in Germany's case, as we discussed in a prior interview, it's been quite remarkable, because Germany, I believe, wants more than 300 tons returned to them. And initially they were told no, you can't have it, which is a remarkable thing for a friendly central bank to say to another friendly central bank. And now, as I understand it, after 2 years of waiting, a deal has been brokered in which supposedly the gold will be returned over 7 years. It's not as much as was originally requested, and only a total of 27 tons was returned to Germany, 22 of which came from Paris. Only 5 tons came from the New York Fed, and it wasn't the gold that Germany originally, had on deposit with the Fed. It was different gold. It had to be melted down, tested for purity, and recast in what are called good delivery bars.
And this is suspicious in itself?
Well, there are many things that are suspicious, but certainly I think people should inquire, since it wasn't apparently the gold that was on deposit with the Fed. Why was only 5 tons returned? Because if you're going to return different gold anyway, then it should have been possible, particularly with the Fed having access to a digital printing press, to go into the market and buy whatever quantity of gold Germany demanded to return what was rightfully theirs. Now, the fact that this wasn't done and this whole nonsensical story was created, which the Bundesbank plays with, same script as the New York Fed, that there were all kinds of logistical and other reasons that only 5 tons could be returned. I think anyone who understands the gold market and understands what really happened sees that as just being comical. I mean, it's almost hilarious when you think about it, that people would take that kind of story seriously. And what it points to, as much as anything, I think, is the self-interest that central banks generally, including apparently the Bundesbank, had in continuing the price suppression scheme we've discussed, and in not being seen to have to go into the market to buy sizable quantities of gold. They want the price lower, not higher.
How does an artificially low gold price work against the public purpose?
I think it's several ways, Lars. In the first sense, it discourages people from saving in gold, which in my estimation is one of the very few safe asset classes that exist in the world today. So it increases trust that is not deserved in the banking system and in fiat currencies, and decreases confidence in gold and other precious metals in which people should properly be saving some portion, of their assets. So that's the first way where I think directly it can do harm. The second and possibly more important way is, again, it allows the perpetuation of these policy measures, which are likely, in my estimation, to lead to the next financial Armageddon, in which a lot of people could be hurt, and many people are saying ultimately may usher in the next depression, not the next Great Recession, but something potentially much more serious. It allows the perpetuation of flawed policies, which inevitably could lead and likely will lead to very unfortunate economic results for people. In other words, these flawed policy measures would be nipped in the bud by a price of gold that just kept racing higher. And banks would have to address it, and the public would respond in ways that can be expected, so that there would be a limited shelf life, so to speak, to flawed policies. And the fact that the shelf life is being extended by suppressing the price of gold has the unfortunate consequences of making the next collapse, that much more serious.
Would you also say if the gold price wasn't rigged, the conditions under which mining happen would be better for the workers, the environment?
Oh, there's no question. I think one of the obvious casualties is the mining industry to these policies. You've got, at the moment, with the gold price below 1,300 and still under pressure, you probably have at least 40% of mine production that is not profitable. And among the junior mining sector, it would be much higher. So jobs are being lost. Some mines have already been shut down. People are being hurt. The entire industry is being hurt. There are very few highly profitable miners anymore. And if this goes on for an extended period, the consequences to the industry, not just the junior mining industry, will be extremely severe.
But would you say in the long term, the stock mining companies, you could really make a fortune with them?
I think it's possible. I mean, traditionally, mining companies are like levered warrants on the physical price. So a case can be made, and certainly this year has been pretty good for a number of miners, despite the fact that the price, again, is under pressure. You can make the case that if we do see much higher prices for gold, that people could make much more money in the miners than owning the metal. I think the risk here, again, is confiscation. The risk is taxes. There are a number of risks, including execution risks to individual miners. All you have to do is look at the nightmare that is Barrick to appreciate the execution risk. And to be fair, not that anyone should be fair to Barrick, this is a very difficult industry. So investors are taking layers of risk in owning the miners that they don't take in buying physical gold and storing it out of the banking system.
One final question. What do you see as the end game, the financial end game?
Well, I think the financial end game is one in which the central banks can no longer flywheel the delivery in conjunction with the bullion banks of the physical gold necessary to keep the suppression game going. And at that stage, what I think we will see on a systemic basis is what we've already seen on a much more limited basis. I mean, already about a year ago, two important European bullion banks essentially declared force majeure. They got out of the gold trading business, and their paper contracts were settled for cash. So people who had a note from ABN AMRO or a note from Rabobank that said, you know, this is as good as gold, you know, they didn't get their gold. What they got was cash at, you know, the agreed market price that is in the contract. Now, what I would suggest is that in the end game, this is the template for how the system will settle. And these claims of 92 or 100 to 1 or whatever they are will almost entirely, these paper claims, be settled for cash. And at that point, I would predict an enormous reset higher in the price of physical gold. Physical gold will first of all go into hiding, as one would expect. It will simply be hoarded. And secondly, 90 to 100 claims on each physical ounce, those owners will attempt, partly with the cash that they received at the low price, to scramble and put themselves in the position they thought that they were originally in. So when, let's say, the COMEX does what Rabobank has already done and settles everybody forcibly for cash, and the price shoots higher, many of these owners will attempt to put themselves in the position they wanted to be in the first place, and they'll attempt to buy at much higher prices physical gold. So my prediction is at that point in the end game, gold goes bid only, and it will take an extremely high price to entice people who had made the intelligent move to own the physical and store it outside of the banking system. Will take a very high price to entice them to meet that demand.
Mm-hmm. Okay, thank you very much.
Thank you.
Okay. Ladies and gentlemen, this was our special interview with William S. Kaye, and on behalf of Matterhorn Asset Management, I say thank you for watching.